Good morning, students. This is Nagarajachari, Faculty of Commerce, working in MBS Government Arts and Science College. Regularly, we are I'm doing video lessons. So, in this video lesson, it is very useful to become sixth semester students. The subject is managerial accounting. In that second unit, that is marginal cost. In marginal costing, I have completed two video lessons. This is the third video lesson. In previous video lesson, we discussed about marginal costing, absorption costing, differences, methods. In both the methods, how do we calculate a profit? So, through the marginal costing, we may find out marginal cost equation. So, like that, we have in each method advantages and limitations that we discussed in previous video lessons. In these video lessons, we are going to discuss about, let us see what points are we are going to discuss. So we will see, these are the outcomes we are going to learn through this video lesson. First one, break-even analysis. What are the assumptions are to be considered through this video lesson? Assumptions. What are the assumptions considered through this video, through this break-even analysis? Assumptions are to be considered in break-even analysis, and uses. What are the uses in break-even analysis? And CVP analysis, cost, volume, profit analysis. That is also discussed through this video lesson. And what are the elements are involved through this in this CVP analysis that we discussed through this video lesson. And marginal cost equation. So marginal cost, how do we calculate it? Variable cost. To calculate variable cost, sales, fixed cost, profit. To find out fixed cost, to know profit, some. So earlier in the previous video lesson, the statement format we have been seen the marginal cost statement, that is income statement, that we have seen in previous video lesson. In this video lesson, marginal cost equation, the equation form also we may calculate profit. So contribution margin, how do we get contribution margin also we discussed in this video lesson. And margin of safety also we discussed in this lesson. So these are the outcomes, these are the items what we are going to discuss through this video lesson. Please listen carefully. So we will continue this video lesson. So we are going to continue this video lesson. These are the topics. So let us see from break-even analysis. So generally, break-even analysis. Break-even analysis is a logical extension of marginal costing. It is based on the same principles of classifying the operating expenses into fixed and variable. Nowadays, it has become a powerful instrument in the hands of policymakers to maximize profits. So, to maximize the profits, firm's profit. So, it is a tool, it is an instrument. So, break-even analysis it is very useful to the decision makers. There may be change in the level of production due to many reasons. Yes, definitely. There are many reasons. The level of production may change, such as competition, introduction of a new product, trade depression, or boom, increased deemed for demand for the products, scarce resources, change in the selling prices of products, etc. such as cases, management must study the effect on profit on account of the changing levels of production. A number of techniques can be used as an aid to management in this respect. One such technique is the break-even analysis. The term break-even analysis is interpreted in the narrower as well as broader sense. Used in its narrower sense, it is concerned with finding out the break-even point, level of activity where the total cost equals total selling price. Used in its broader sense, it means that that system of analysis which determines the probable profit at any level of production. The break-even analysis establishes the relationship of cost, value, and profit. So this analysis is also known as cost, value, profit analysis. So there is no change in, there is no differentiation between break-even analysis and the cost, value, profit analysis. So it is also known as the same analysis. So generally, break-even analysis is a tool, the technique. It is very useful to the management. So to take decisions, so it is very useful to the management. How it is useful, we discussed. So generally, break-even point is a position. Break-even point is a position. In that position, the total cost will equivalent to the what we get, what we are going to get, that is returns. So that is nothing but selling price. Selling price equivalent to the total cost. That means whatever the cost is incurred on that product, that is equivalent to the selling price. That means above the total cost, what we are expecting, that is returns. Returns we are expecting, that is profit. So above the break-even point, we are going to get profit. Below the break-even point, we are going to get losses. So that's why, based on this, it may be profit point of view, it may be production point of view, whatever it is, the break-even point is very useful to the management to take decisions, accurate decisions, and better decisions. So it is a technique to the management where we follow to get desired profit, to get desired production. So how much profit we are going to get on the above break-even point. So that's why it is very useful to the management. So in the same way, cost, how much cost is incurred, how much production we produced, value of production, and how much profit we are going to earn. So how much cost is incurred, how much value of production we produced, how much profit we are going to get. This analysis is required to the management because they are the investors. So this analysis is very useful to the management. So BVP break-even point analysis is nothing but CBP analysis. So in this break-even analysis, these three elements are involved. So some assumptions are to be followed in break-even analysis. So that's why let us see one by one. Following are the main assumptions underlying break-even analysis. Fixed costs remain unchanged at all levels of activity. So at any level, there is no change in fixed cost. So that's why fixed cost remain constant at any level. So it may be low level, what we say, high level, and whatever it is. In all the levels, uh, fixed cost is remain fixed. Fixed cost is remain fixed. So that's why it is no change at all. Fixed cost is fixed. So that's why that is the assumption. So fixed cost is fixed when we are calculating break-even point. So fixed cost is fixed. This is an assumption while analyzing this point. And one more, a variable cost change in direct proportionate to the value of output. So whatever the volume of output is there, uh, this uh, this is directly relevant to the variable cost. If volume of production may increase, volume of variable cost also may increase. If volume of output may decrease, volume of variable cost also decrease. So if there is no production, there is no variable cost. So that's why it is directly dependent upon uh, production. So that's why variable cost change, the value of variable cost depends upon directly proportionate to the volume of output. That is also another assumption. And the cost can be classified into fixed and variable. So that's why here under marginal costing, we are taking two types of two types of cost, that is fixed cost and variable cost. These are the two types of classifications we are taking as assumption. And one more, selling price remains constant irrespective of value, production, sales, and the changes. So selling price remains constant. It is that is also one assumption, irrespective of value, production, or sales, whatever it is. Price of raw materials, labor rate, and remain constant. So raw materials and labor also remain constant while analyzing these break-even analysis. Next, what are the uses with this break-even analysis? Let us see. So it helps in determining the selling price, which will give desired result, desired profit. So it is very useful to the management in determining the selling price with the help of these break-even point. So where we are uh, equaling the total cost and the selling price. After that, our profit will be um, expected. So that's why above this point, the profit will be taken into consideration. Below the point, that below the total cost of selling price. So that's why it helps in determining selling price to get a desired level of profit. And next point, it helps in forecasting cost and profit as a result of change in value. That is also, it is possible. It can be predicting the cost, profit, so to get the level of change. And the next point, it helps in fixing sales value to cover a given return on capital employed. So whatever the capital is there that is to be employed to get a return on capital employed, uh, it is fixing the sales value. So how much capital we are utilizing, how much sales we are doing. So that is possible to fix with the help of this break-even analysis. So it can be calculated through this. We can compare how much capital employed we utilized and how much sales we done. So it can be useful comparing. It helps in determination of cost and revenues at different levels of output. So yes, different levels of output we may classify the total cost and the total revenues. That is also possible. That is also uses. And it studies the impact of increase or decrease in fixed and variable cost on profit. Yes. So the impact of fixed and variable cost on profit. So the fixed cost impact on profit, the variable cost impact on profit, that can be separately uh, analyzed through this analysis. And inter-firm comparison of profit is made possible. So within the departments or firm to firm comparison also can be made possible. So these are the uses of break-even analysis. And elements cost, how much cost is incurred, and volume, how much volume of production we are produced, uh, how much profit we are going to get. So this is a CVP analysis. So the variations in cost and profit in relation to changes in the volume of output and sales, though a large number of internal and external factors influence the amount of profit, the volume of output and the sales are the important factors influencing profit. The three factors CVP analysis are interlinked and interdependent. Yes, definitely. How much cost we incurred, how much cost incurred on a product, how much value we are produced, how much value we produced, how much profit we earned on that. So these are the three factors are internally linked with one and each another one. So that's why, as we know, that profit depends upon sales. Selling price to a great extent depends upon cost. Volume of sales depends upon volume of production. So which in relation to cost. In CVP analysis, an attempt is made to measure variation in cost and profit with variation in value. So that's why uh, these are the interlinked uh, factors: cost, value, profit. So these are the three interlinked factors. So that's why the management can study these cost, value, and the profit uh, interlinked factors are to be observed, analyzed by the management, then take decisions. So that's why the relationship between cost, value, and profit. If value is increased, the cost per unit will decrease. So the relation, how it is relevant, how it is dependent, interdependent. If value is increased, the cost per unit will decrease. The cost, if the value is increased, the cost per unit is will decrease and the profit per unit will increase. So this is the relation between three internal these three factors internally linked. Thus, there is a direct relation. Volume of volume of production is increased, the cost will be reduced. At the same time, profit will be increased. So volume of production is increased, profit will be increased, cost price will be decreased. So that is the interlink between these three factors. So direct relation between value and profit, yes, but inverse relation between value and cost, yes, definitely. Management accountant, these analysis may be applied for profit planning, cost control, evaluation of performance, and decision making. So uh, these are the action. Uh, these are the what we say tools, techniques for the benefit of the management, profit planning, cost control, evaluation of performance, and the decision making. It is very techniques are very useful to the management. So, with the help of these CVP analysis, these techniques are to be analyzed. The main objectives are to be followed as these analysis helps to forecast profit accurately, and the relationship also can be studied. This analysis is useful in setting up flexible budgets with indicating cost various levels of activity. So it is interlinked. So that's why uh, one another can be studied. And this analysis, so CVP analysis is very useful to the management. So in performance evaluation also it can be used, and formulating price policies also it can be helpful, and overhead analysis. We may say predetermined cost also can be possible because of this marginal CVP analysis, and makes possible to attain target profit by locating the volume of sales required for each profit and finally achieving such sales value. So these are the objectives of CVP analysis. So let us see what are the elements are involved. So as we discussed for now, cost, value, profit. These are the elements are involved in this one. So the relationship between cost, value, output, and profits. It studies the effect on profit on changes of value. So, in order to understand the mathematical relationship between cost, value, and profit, it is required to understand the following concepts, which can be treated as elements: cost, value, profit analysis. So, to understand a CVP analysis, one should know marginal cost equation. What is marginal cost equation? And the contribution. What is contribution margin? And the profit value ratio, PV ratio generally we say, and the break-even point and the margin of safety. These are the elements are involved in CVP analysis. So let us see one by one. First one, marginal cost equation. So for the sake of convenience, it is written like this as an equation. So sales equaled variable cost plus fixed expenses plus or minus profit or loss. Or you can say sales minus variable cost equaled fixed expenses plus or minus profit or loss. Or we can say S minus V equaled F plus or minus P. So here, so this is marginal cost equation. So how do we get sales value? So the total cost, the total cost, variable cost and fixed cost is there. So the total cost, the management, uh, while determining the price of the product, is taken into consideration total cost. To that, the profit is to be added. Then selling price will be determined. So while determining the price of the product, before that, the management will know what is the cost of the product. In that, the cost of the product is variable cost and fixed cost. That's what we are observing here in the equation. So this is variable cost and this is variable fixed cost. So a management expectation. Generally, management what expects profit will expect. So sometimes may not possible to get profit. Then ultimately we means management. Ultimately, the concern will get profit. Always expect profit, but sometimes when not possible to get profit. So that's why loss may be incurred. So that's why sales minus variable cost, sales minus variable cost equal fixed expenses plus or minus profit or losses. So that's why. So this is marginal cost equation. So this is very helpful to know one from the other one. So three elements are given, the remaining one can be possible to calculate. So let us see from this example, determine the amount of fixed expenses from the following particulars. Here what we have to find out, fixed expenses we have to find out. So sales rupees 2,40,000, direct material 80,000, direct labor 50,000, variable overheads 20,000, and a profit 50,000. So sales is one element. So that is given. Direct material, direct labor, and variable overheads. These are the three elements are to be included in variable cost. So that's why variable cost has come. And the profit, the another one is profit. So what we have to find out? Fixed expenses we have to find out. So that's why marginal cost is equation is like this. So this is marginal cost equation. So here sales are 2,40,000 and variable cost is, so the three uh, costs are included. Direct material that is 80,000 and direct labor 50,000 and variable overheads 20,000. So these are the three uh, expenditure are included as in variable cost. And the next profit is given 50,000. Now what we have to find, fixed cost is to be find out, that is not given in the problem. So from four elements we know three elements, so remaining one it can be easily find out. So whatever we have given the values, the values are to be substituted in the equation. So now 2,40,000 is the sales and 1,50,000 is the variable cost. We don't know fixed cost, that's why same is to be written as F. And the profit is, if profit is there, then you have to take plus. If loss is there, you have to take minus. So that's why plus 50,000. So it is simplified. Ultimately, we get 40,000 fixed expenses. Now it can be cross-checked with the help of these fixed expenses. So sales minus variable cost, how much we get? So then you see 2,40,000 minus 1,50,000, 90,000 we get. Yes, definitely. And fixed cost plus profit. We know already profit, that is 50,000. Now we know fixed cost. So 40,000 plus 50,000 also 90,000. Both will be equivalent. So this is marginal cost equation, and it is very important. From this equation, most of the elements have to be derivated. So please concentrate on it. Most of the students may confuse in margin costing equation, marginal cost equation. So that's why don't get confusion. In normal parlance, the total cost is to be taken into consideration while determining the price of the product. To that, the profit is to be added. Then ultimately we are getting selling price. So that's why in normal parlance, when we are purchasing a product, uh, seller may say we don't get profit when we are selling this price on that rate. So like that, so one can understand easily. So that's why marginal cost equation is very easy and is simple to understand. So be concentrate on it. Next, contribution. Contribution is the difference between sales and variable cost, or we can say marginal cost. And we can say one more thing, and the sum of fixed expenses and profit. In that way also we can say, or we can say the difference between fixed expenses and loss. That is, in that way also we can say. So that's why contribution can be said. Contribution can be said the selling price minus marginal cost, or we can say fixed expenses plus or minus loss. So in that way also we can say. So the difference between selling price and variable cost. And how do we get profit? Profit is a net gain in activity or surplus that remains after deducting fixed expenses from the total contribution. So profit is equal to sales minus total cost. Sales minus variable cost plus fixed cost. Contribution minus fixed cost. So in this way we can do profit. And earlier we did in the statement format, but here we are doing the equation format. So don't get confusion. So difference between contribution and profit. So what are the differences between these two? It includes fixed cost and profit, where in contribution. It does not include fixed cost, that is profit, based on marginal cost concept. So contribution is a uh, technique. Contribution is a tool, what we say, it is a tool under the method of marginal cost. And it is a common concept. So whatever the method, it may be absorption method, it may be marginal cost method, ultimately we are going to get profit. So that is common concept. And contribution above break even point contributes to profit. Yes. So above the break even point, it leads to profit. And below the break even point, it leads to loss. And whereas profit is expected only after covering variable cost and fixed cost. So after beating the fixed cost and variable cost, then only profit can be uh, profit can be known. Profit can be known. Otherwise, loss can otherwise may not be possible. The next contribution analysis requires a knowledge of break-even concept, definitely, and profit does not require any such concept. These are the differences between contribution and profit. So, and you see again PV ratio, profit value ratio. So it is also known as contribution by sales ratio. So the name itself indicates PV ratio, contribution by sales, is to be multiplied with 100 by because this is ratio. So fixed expenses plus profit by sales. That way also we can calculate this contribution sales ratio. And next, margin of safety. Margin of safety is the difference between actual sales and the break-even sales. The difference between actual sales and the break-even sales is margin of safety. It represents the shock absorbing capacity of business. The larger the difference, the better it is. A larger difference means that the business is more sound and has a greater capacity to bear loss due to price reduction and vice versa. One of the assumptions of marginal costing is that output will coincide sales. So margin of safety is also excess production over the break-even point's output. Sales or output beyond break-even point is known as margin of safety because it gives some profit. At break-even point, only fixed expenses are recovered. Margin of safety can also be expressed in percentage. Okay, so let us see margin of safety. Now, through these formulas, margin of safety calculated like this. First formula, margin of safety is the difference between actual sales and the break-even sales. If it is positive, we are getting positive value, then we are in margin of safety. If it is getting negative value, we are in negative in margin of safety. That means above the break-even point, below the break-even point. Okay. Next, margin of safety can also calculated with the help of the following formula. So margin of safety is equal to profit by PV ratio. Sometimes maybe asked in units, then profit by contribution per unit, and sometimes percentage also can be asked. Actual sales minus break-even sales by actual sales into 100. That way also we can calculate. And contribution. So the relation between contribution and margin of safety is equal to break-even sales plus margin of safety has to be multiplied with PV ratio, then we get contribution. Or in another way also, break-even sales PV ratio, margin of plus margin of safety is to be multiplied with PV ratio. In that way also we can calculate. So this is margin of safety. So the uh, above value of break-even point is known as margin of safety. Okay. Anything else? Any doubt? I think every student has to get clear-cut idea about marginal cost equation. From that, the derivations are to be known. Contribution, profit, and PV ratio. Like that, margin of safety. The other elements are to be known, and more practice may get more uh, what we say more knowledge. So that's why each student has to get more practice from the problematic point of view. So uh, let us see some of the problems. So here you see fixed cost is given as 2 lakhs 40,000 and the variable cost per unit is given 15 rupees per unit and the selling price per unit is given 30 rupees. So find out break even sales in units and if the selling price is reduced by 10%, what will be the new break even point? So this is the problem. So let us see uh, the solution. So here you see fixed cost is given as 2 lakhs 40,000. So first we have to know what values we have given, whatever the information we have been provided in the problem. So with the help of that, we have to go. So that's why first break even point in break even sales in units. So to that the formula is fixed cost by selling price per unit minus variable cost per unit. So 2 lakhs 40,000 that is given in the problem. This is fixed overheads by selling price 30 rupees per unit minus 15 rupees per unit. Then ultimately we get 16,000 units. So whenever the firm reaches to 16,000 units, then there is no profit, there is no loss. So if the company sold out 16,000 units, whatever the total cost is incurred, that total cost will be equivalent to the whatever the returns he got. So that's why 16,000 units is the target. After that only he may get profit. Okay. So next you see second one.
If the selling price is reduced by 10%, what will be the new break-even point? Here you see break-even selling price is to be reduced by 10%. So present selling price is 30 rupees, isn't it? So present selling price is 30 rupees. In that, 10% is to be reduced. That is 3 rupees. Then ultimately, the new selling price is 27. Now you see fixed expenses. There is no change in fixed expenses. Only variable cost is changed. So in this case, selling price is the condition is only selling price is to be reduced. Remaining is to be constant. So that's why uh, right fixed 15 rupees. Variable cost is 15. Now, if the price of the product is reduced by 10%, we have to increase 4,000 units to meet the total cost. Okay, so earlier it was 16,000 units, now it is 20,000 units. So, in the earlier case, the firm has to reach 16,000 units to get total cost, whatever the firm is incurred on the uh, product, incurred in the production process. But whereas if selling price is reduced by 10%, in this case, in the second case, the firm has to reach 20,000 units. Okay, right? This is the problem. This is the application part. So we studied theoretical part. This is application part. Okay, now we go for second problem. Profit 200 rupees, sales 2000 rupees. Variable cost 75% of sales. Find out break-even sales. What would be the sales value to earn a profit of rupees 500? Right now, we know the sales is 2000 rupees and the variable cost is 75% on sales. That is 1500. Now, contribution is 500 rupees. Right now, PV ratio is equal to contribution by sales into 100. Contribution is 500, sales is 2000. Then ultimately we get 25%. So PV ratio is 25%. So with the help of contribution and PV ratio, we are going to calculate break-even sales. Fixed expenses by PV ratio. So fixed expenses is 300 rupees. No, fixed expenses. We don't know what is the fixed expenses. What do we say? Yes, definitely contribution. Yes, right. Contribution is 500. So fixed expenses is the difference between contribution and profit will be 300. So 300 by 25%. Then ultimately we get fixed expenses. That is 1200 rupees. So sales value to earn a profit of rupees 500. So here desired profit. So fixed expenses plus desired profit by PV ratio. Then ultimately we get 3200. This is the second problem. So let us see third problem also. Third or fourth. Let us see fourth one. From the following figures, you are required to calculate PV ratio, break-even sales value, margin of safety, and profit. So PV ratio is contribution by sales, contribution by sales into 100. That is 2000 by 4000 is to be multiplied with 100. Then we get 50%. Here, contribution is the difference between these two sales and variable cost. So that's why sales and variable cost difference is 2000. Then ultimately we get 2000 contribution. So break-even sales fixed cost by PV ratio, that is also we get 3200. And the margin of safety, actual sales minus break-even sales, that is the difference between 800. So or you can say in this way also you can calculate profit. Here marginal cost equation 400. So like this, each and every aspect of the decision making part. So what are the fixed cost? What is the variable cost? What is the profit? What is the output level? At what level we are going to get what profit? Desired profit. How much profit we are going to get? So to earn that profit, how much we have to sell the products. So that is also it can be possible like that. All the uh, whenever we are doing problematic part, application part, we can analyze more and more. That's why students, your I'm guiding to you, I'm instructing to you. So practice more number of problems, then you get more idea about this marginal costing methods, and you're going to master in this topic. Otherwise you won't get master. So that's why please concentrate on more on the problems, and do analysis part. So how much profit is incurred, how much sales, how much is classified. So more cost, more value, more volume leads to more profit, less cost leads to more profit. So that's why with this uh, with this I'm going to conclude this video lesson. Now please understand the concept of marginal costing and the absorption costing. In marginal costing, the segregation of cost is possible. In absorption costing, segregation of cost is not possible, but it can be done um, to know the profit. So, um, absorption costing is a traditional method. Marginal costing is a latest topic. So, concentrate on the both the topics. So, with this, I'm concluding this session. So, thank you, one and all. Thank you very much.